Hi, my name is Leah Bennett. I am the president of Westwood Wealth Management Houston. I'm also one of the portfolio managers on several of our wealth strategies. Um, Thank you all so much for joining us with a very topical topic. I'm also joined by Adrian Helfert, who is our Chief Investment Officer for our multi-asset complex, as well as Bill Costello, who is one of our senior portfolio managers who oversees our small cap and mid cap strategies. And Bill also has a background on energy, which I think will be really relevant to this conversation. So first of all, welcome Adrian and Bill. Thank you guys for joining us.
Great, thanks for having us.
Thank you for having us.
Thank you so much. So this is a very interesting point in time. We've obviously seen a big recovery in the prices of commodities and finished goods as we're coming out of COVID. Also, couple that along with a lot of stimulus, and there's all these questions about inflation. So to kick off the conversation, there is this ongoing debate whether or not the current elevated prices, especially in finished goods and labor, are they transitory or are they structural? And to start with, I'd love to know your thoughts, Adrian. And can you first start with a definition of transitory and structural?
Great, thanks. Thanks for being here. I think that's an important place to start, actually, because this is not really a term that we used beforehand, and that is the big market topic right now, transitory inflation. It's been really introduced by the central bankers as an excuse, I think, to keep rates low, to keep the party going. They've mentioned this in the context of several months of transitory inflation, of elevated price increases because of demand and the supply chain lags. We saw this directly in a statement from Chairman Jerome Powell, said something akin to, during his time of reopening, we are likely to see upward pressure on prices, but prices are likely to be temporary as they are associated just with the reopening process. That's the mentality of the central bankers. Structural inflation means a longer period of higher inflation, likely both in labor and goods prices, that's persistent. And it's persistent because of changes in demographics, changes in globalization, current political agendas. There are many economic rationale for why we might see longer periods of inflation that could be damaging. There are deflationary forces at work, things that pull down the rate of inflation. Those are things like the government debt load, which of course is very high, as we all know. The eventual trail off in fiscal stimulus. We've had this great fiscal stimulus that has pushed money into the environment, that has put money in consumers' hands so they can go purchase, driving up inflation. That can't go on forever. And of course, technological disruption in areas of the economy. Finally, at some point, the Fed does need to rise the base rate. And when they do, that's a deflationary topic. One thing that I think it's good to think about is, well, is inflation bad? Is it good? What's the bad or good of inflation? It's considered to be bad, high inflation. Generally, if you just say inflation, I think you get fears in your inside. It can be dangerous for your erosion in purchasing power, for lower debt values. Subsequently, the potential for more constrained lending conditions for companies. Some level of persistent inflation is deemed to be good, which is why we have a 2% expected inflation by the Fed. They want that because they want a little bit of purchasing power. The theory that it keeps people spending and continually reducing their debt load, but not too much. And of course, the days of old, inflation was super scary. Ronald Reagan, in a very older statement, said something akin to, inflation is violent as a mugger, frightening as an armed robber, deadly as a hitman. And that's the old psychology. Now, at nearly 43 years old, the average American worker has never in their career seen inflation, core inflation, above 3%, and they just did in April. So changing psychology.
Bill, what are your thoughts?
I basically agree with what Adrian has laid out there. I think it's important to differentiate between transitory and structural. I think, transitory is much more tolerable to some degree, whereas structural, depending on how it plays into the investment thesis, can be very damaging longer term. I do think there are a lot of offsets to the inflation, and Adrian mentioned them with the technological innovation that we've had, automation, that type of thing. It's been going on for years. I would think that a lot of the companies are going to adopt even more as far as that goes. Different measures, whether it's artificial intelligence to help them design things better. Or anything along those lines. We see a lot of it in like the food service names that we own and the restaurant chains, where they're really kind of reimagining their business and redesigning some of the workflow that goes into even something as simple as making a pizza and having the process a lot more automated. And ultimately, you'll see that, using that same example, probably into some of the delivery methods that go into delivering that to the consumer, where they're always trying to cut costs out of the system because there are structural challenges to them, certainly wage inflation for one. And then, another question that affects them is the food inflation that's in there, whether it's the cost of beef, the cost of pork, any of those which are pretty high right now. You know, is that structural or is that transitory? Right now, most people would view that as more of a transitory issue, uh, but that's a question that really remains unanswered, and we won't know until time progresses.
Yeah, I mean, I think it's really interesting. You did see, you were seeing a pickup in productivity before we went into to COVID, and then COVID has really re-accelerated the trend because of the adoption of technology. I mean, we've had a massive adoption during the last 12 months, and I know if you look at technology as a percentage of nominal capital spending, now it's now 51%, which is an all-time high, and it will be interesting to see what sort of influence that does have. Obviously, that will help from an inflation perspective for sure. But again, just a really interesting point in which we're emerging from this. Um, Again, we do talk about this structural change versus transitory. And I'm kind of curious, Adrian, how long do you think a transitory period can last, and what are your risks kind of to your thesis?
Sure. Well, you said, I do believe, we'll see transitory inflation, as Bill was saying as well. That means deflationary forces eventually look to offset some of the inflationary forces for a balance within reason. But right now, supply chain constraints, pent-up demand, extraordinary levels of high savings rate for the United States, continued drop in the unemployment rate, all that leads to a potentially longer and potentially scarier rising goods inflation, with a hopefully healthier offset from wage inflation. We already do see some of this happening. We saw last week the recent data with job openings that is at a record high. Today, we saw the producer price index, which is a measure of inflation, rising 6.6% annually. That's the highest since the series goes back to 2010. That will eventually lead to higher goods prices for consumers. Savings rates, of course, with less ability to spend, Americans have definitely saved. The savings rates hit levels that we've not recorded in 7 decades during the crisis. All that eventually leads to, maybe it's even mortality of all of a sudden, oh my gosh, how long are we going to be here? Let's go buy some new shirts. So we do have a spending impulse, I believe, that is coming. How long is the key question, truly, whether it defines transitory or structural. If the reopening continues without a hitch, that hitch could be something like a new COVID variant that leads to a further shutdown, or supply chain constraints that are stronger than we expect. I think we'll see elevated inflation statistics through the first quarter of 2022, which is longer than that couple of months that I just quoted from Chairman Powell. Long enough for I think the market to question the Fed's transitory assumption, long enough to get nervous on debt pricing, leading to yields moving higher. The risks to that thesis are, as we'll find out today and tomorrow with the Fed coming out, how the Fed reacts to this. At what point do they start to reduce the size of the balance sheet, which is pulling back on some of the stimulus, pulling the punch bowl effectively? How fast do they do that? They've given the indication right now that they will consider inflation transitory until they're absolutely proven otherwise. Um, so we'll see how that goes. Economic growth in the reopening is measured in terms of things like mobility statistics. That needs to continue for inflation to continue. That'd be a risk if we see mobility retrench, which is why I talk about a new COVID variant. And the fiscal plan, finally, we have the fiscal plan that we've been discussing as a new fiscal plan coming forth. If that gets pulled back in terms of how much fiscal impulse we have, that could be a risk, which means midterm elections all of a sudden are in view as a catalyst.
And Adrian, I've heard you use examples and talk about, you and I have talked about this timber versus lumber. And I think that's one situation where you're finally starting to see some relief, but where you've seen timber at all-time lows, but lumber prices have been exceptionally elevated because of all the supply chain issues and some of the problems there. And you finally have seen a break in lumber prices as production is finally catching up. I think lumber prices are down about 40% from their highs, but it is interesting to continue to monitor each data point and see how long it takes to kind of work through these issues if they are transitory for sure. Bill, what are you seeing in some of your companies? Do you think the challenges are more long-term hurdles, or do you think it's more transitory?
Most of them seem to be more transitory from what we've talked to. And I don't know if that's just companies not wanting to admit that there are some issues there that they've got to deal with and kind of hoping to a degree that things get better and they go away. But in general, they do talk about it being transitory, whether it's, as I mentioned, like the restaurant chains with different food costs that are going through the system that are higher right now. They see that as more short-term in nature, uh, at least at this point in time when they talk about that. When I talk to my energy companies and I'm talking to them about the costs of drilling a well, most of them think that the well costs are going to go up a little bit this year as far as the cost to fully complete a well. A lot of that has to do with the amount of steel that you use in an oil well, the rods that go down there, and the tubing, tubular steel. They see some upward pressure on that because steel has been one of the commodities that's, gone up dramatically. Now, fortunately for the oil companies, there's a couple offsets. One is steel is a big cost, but it's not a huge cost. So even if steel prices go up 50%, overall it doesn't affect the total cost of the well to that degree. And the other services that they use, whether it's renting a drilling rig or the pressure pumping crew to frack the well, we have oversupply of both of those. We have plenty of rigs. We have more rigs than we need or could put back to work in any fast period of time. So that has a cap on the upward price that a drilling contractor can charge for the rig. Um, the other thing is we've had a lot of technological advances over the years, and the oil industry is really part of the forefront of that to some degree, even though it doesn't get thought of as a highly technical industry. But the cost to drill wells and the time it takes to drill the wells have come down so dramatically that even that little inflation doesn't seem to bother them at all. What I'm more interested in is a couple of the names we own in SMID and a couple of the manufacturing companies who have to pass through that steel price to a consumer, whether or not even just a consumer like you and I, but company that sells, let's say, ovens to a restaurant. And ovens, refrigerators, stainless steel is a big portion of that. And right now, with supply chain issues that we have, um, I know the woman in my condo building downstairs just was ordering a dishwasher. 5-month wait to get a new dishwasher in. So there you have those supply chain issues, which I think that will be transitory. We'll work through supply chain issues in most industries, but I wonder about ultimately passing on those costs and what happens. Who does the margin shrink or does the consumer pay more? It's truth probably lies somewhere in the middle, but I think those are the challenges that we hear from our companies.
Which makes sense. Adrian, I mean, we've talked a fair amount about technology in general and just this massive adoption that we've gotten in technology the last 18 months. I mean, how does innovation kind of factor into your thoughts?
Sure. I mean, it's something I think is underappreciated. And we were having this discussion prior to COVID, actually. CPI was remaining low and almost, I mean, putting at question our old economic paradigm of the amount of monetary stimulus should push up CPI or consumer price inflation. And I think technological adoption and disruption was involved in that. It's impacting the reported inflation numbers, maybe even the way they're actually measured. And so, we've seen now pull forward just by consequence of things like Teams that we're on now, presenting innovation and technology are changing things. That we pulled forward the adoption of these things by maybe several years in some cases. So that could be a deflationary market force, either by introducing inefficiencies or new productivity in new ways, reducing price competition in some markets. Bill was talking about the evidence of where he's seeing that disruption in energy markets. Even just think business class flights, the expensive business class flights. Seat prices could potentially drop as this new competitor of Microsoft Teams could be used for a business meeting instead. It doesn't mean always, but it's price competition. I certainly will start thinking about the level of input cost for the meeting and at what point do I achieve that. So certainly some technological adoption is here, and it could be a deflationary force.
Yeah, and I think it's super interesting to think about how I talk about frequently, it takes 3 weeks for people to form a new habit. And you think about where we were March a year ago and just the things that are mainstream now. You mentioned Teams as an example. My mom is 82 and really was not that adept with technology. And she uses Shipt now to buy her groceries and orders things on Amazon. And it's just interesting how embedded it's been in our culture and what that is going to look like moving forward. Just what does the new norm look like? Again, it's just kind of fascinating. I do have a question for you about interest rates because it is interesting as far as what we've seen in the market. So we've seen the 10-year, it actually moved up, I think just above 1.7%. Which was a little stress on the market back in, I think it was around April or so. And then we retreated back to around 1.4%, and now we've moved back up. So what does that tell us within the context of this conversation about inflation? What does that tell us about the future, and where do you see rates moving? Adrian, I'll ask you this question.
Sure. I'm the guy that looks at lots of blinking lights and assumes it's my crystal ball and tries to see. And it's funny in that these indications that we sometimes get from markets like the 10-year moving lower over the last 2 months has been interesting in context of all the indications of inflation are moving higher. Not just moving higher, but they've been beating expectations in the market. When we see the job opening survey come out, at the same time, it's beating the expectations of the market. You would expect that interest rates are going to go higher on the back of deflating debt valuations. But that's not what we've seen. As you said, prices have gone higher for treasuries, yields have gone lower. The likely thesis is it's a transitory consideration. The market is expecting transitory at this point. The 10-year is also a proxy for economic growth. So, there could be a signal that supply chain constraints are taking a bit of hold and those extraordinary growth expectations have an effective governor on them, which is supply chain constraints. Lastly, there is a non-fundamental, there's a technical aspect here, which is pension funds, which are a huge holder of U.S. Treasuries at low valuations, or low yields, are finding suddenly that with equity market rising, their funding ratios are nearing 100%. They don't get paid to be over 100% funding ratio for their liability stream to pay out the retirees. So they're starting to lock that in by buying U.S. Treasuries en masse. Not something many retail investors look at, but it's an extraordinary force in the U.S. Treasury market. So reading all of these things together, I think the driving force is a consideration for transitory inflation, but there are other things at large. My view personally is that in the medium and long term, with an intermediate rate, we are going to see them go higher as a context of even at just normal growth rates and normal inflation levels, we are at a low yield. And so if we were to normalize, then we should see interest rates rise, intermediate interest rates rise. If we expand beyond that, we'll see them go further. On the short term, I don't expect much movement. I don't expect much movement because I'm believing what the Fed is telling me. They're telling me that they're going to wait to see the whites of the eyes of inflation before they move on the front end of the base rate. And I'm not going to fight the Fed. Some of the, I'll just end with, when you think about some of these companies and when they start to observe inflation, it's from a fundamental perspective. It's not an immediate perspective. So if you think about floor and decor, they make tiles, other things that are part of the building process in houses, they only turn over their inventory twice a year. And if you're first in, first out accounting, you don't see it until third, fourth quarter in the financials. So the fast turn time of the inventory of companies is not going to start seeing peaking inventory cost until probably the end of the year. And that's the signal that we'll take for when the worst is behind us.
Bill, commodity prices have certainly been on the rise, and I know you follow energy as we've talked about. And what are your thoughts about oil prices?
Oil prices have obviously rebounded dramatically. I think the market is in a very good place right now. It's almost like a Goldilocks situation in some ways. I think you've got the supply side where the OPEC plus community has really restricted the supply pretty well. I think the cohesion that they've had in orchestrating that has been really great for the oil price and for the market. I think if you look at the potential damage to that, or where could supply increase dramatically, there really aren't that many places you could look at. The U.S. producers have shown tremendous capital discipline in the face of higher prices, where they're going to generate a lot more cash going forward. And historically, they would have done nothing but spend all that cash and more. But right now, they've been committed to returning it to the shareholders. I guess they've seen God somewhere along the line and decided to change their stripes as the shareholders have forced them into that move. But that will restrict the U.S. supply, which really was the only growth engine that we had in the world for a while there. The low prices of the past couple years have really hurt like the big offshore developments. So you won't see too many of those come on. I mean, you've got Guyana, which is a big one, and Exxon and Hess have had a string of tremendous discoveries there that are starting to come online. So that'll be a little bit of growth. People are worried a lot about Iran and with the sanctions, what could happen? Could we have more oil put on the marketplace? And I think the answer is yes, but I think there's two things. I think one, the market can absorb it, and two, I think the amount of oil that would come from Iran is vastly overestimated, in my opinion. People are talking about 2 million barrels a day, which is 2% of global supply. It's not an insignificant amount, but I would argue that at least 750,000 of those barrels, if not a million, are really already hitting the marketplace despite all the sanctions we have. I would say they are finding their way to China because I don't think they care about our sanctions. So I think the magnitude of what they could bring to the marketplace and the timing of that is overestimated in the market. And then you've got the demand side of the equation. Obviously, demand was hit very hard last year, and when you look at where demand is in 2021, we won't be back till the 2019 levels, but we'll approach it rapidly. I think by fourth quarter 21 versus fourth quarter 2019, we'll actually be up. And I think 2022 will eclipse 2019. We'll have had 2 last years, but I think that situation will be good for the oil markets. If I look at, obviously the COVID around the world and what's going on specifically in India seems to be a little bit of a hiccup now. But people know that India seems to be relaxing their regulations a little bit and opening up a bit. Now they've got this wave. I don't want to say under control, but it's much better. And in the big scheme of things, India is only about 4.5% of global demand. It's a big component and it's grown fast. But I think that'll come back over time. China is already above 2019 levels. They're showing, the best growth of all the nations in the world. I think the demand, well, it's been slow to rebound, but not unexpectedly slow, I think is really going in the right direction and going there pretty quickly. U.S. demand looks good. We're back around that 2019 levels. So I see solid demand out there, and I really struggle to see it being overwhelmed by supply. So I think we're somewhere in this $60 to $80 world for a couple years. Obviously, that's never a smart thing to say because the markets are always a lot more volatile than you would think. But I don't think we're in a world where we spike to 100. But I think because of the OPEC cohesion, I don't think we would go much below 60 if we did test 60. Barring any other huge COVID disaster where a new variant shuts down all the countries like we saw last year. But barring that, I think we're in a good solid place for oil.
And I think it's the kind of the silver lining with COVID is the fiscal discipline that was that we've seen materialize at a lot of the impacted sectors and industries like energy, as an example. So those are really good thoughts. Thank you, Bill.
Of course.
And I think the last question, we can't have a discussion about inflation without talking about the deficit. One of the questions we probably get the most with clients is really the level of stimulus that's occurring and concerns about the deficit. Obviously, we know taxes are going to go up. There's been several proposals that have been floated out there. There's concerns about what's going to happen with the U.S. dollar. And so I'm curious, Adrian, what is your kind of outlook on those particular topics?
Well, I'm alongside clients. I'm concerned about the deficit too. I'm concerned about taxes too. They're going up. The deficit, just to frame it up, I mean, the sum of the total legislated stimulus packages thus far has been well in excess of $5 trillion. That's more than 25% of our gross domestic product. That doesn't count even the infrastructure packages that are still in the pipeline. That means the federal deficit is likely to come at 14–15% of GDP for 2021 and 22. We'll put back to historical reference of 2009, where this is in totality, this is well in excess of the 10% for 1 year in 2009. We have to pay that money back. And that is the concern of, well, where does that come from? Does it come from extraordinary growth? Does it come from modern monetary theory, which I like to now call more money today? And it kind of remains to be seen what's going to happen there. But those are open questions for the market, for which taxes are going to go up. The deficit spending is large regardless, and we're looking at how we're going to pay that back and the impacts. It's a deflationary force. Now, the dollar and what we do about it are truly two different questions. The central bank is not worried about inflation becoming an issue at this point, as we've discussed, and that's how they're reacting. So that means just keeping interest rates low for a longer period as they have. The dollar, of course, is a relative value instrument. It's not in isolation. It's versus the euro, the yen, the Swissy, other areas. And I think we will likely react slower than others in hiking rates. We already are, relative to our global partners, which means the dollar is likely to go lower from here. In which case, investors are probably well served to have some degree of currency diversification outside the U.S. dollar in their portfolio.
Yeah. And one thing since it is tax day in Texas at least, I was looking at tax receipts. Something that is interesting when we're talking about the deficit, tax receipts are actually so far 279 billion greater than they were for last year, which I think is interesting. And while higher taxes is not good, it is interesting to see that hopefully chipping away at the deficit as well. But it was just interesting to see the increase versus last year. But thank you both so much for the conversation. I think the bottom line is this is something we're monitoring and having lots of conversations about. Before this call even started, Bill, Adrian, and I were talking about portfolio positioning and debating a few things. And I think that's the bottom line for clients who are concerned, and all of our clients are concerned about whether this is structural inflation or not. It's something that everyone who's managing money here is talking about on a continual basis, and we're monitoring and trying to make sure that we're making the right moves. This is a topic I'm sure we're going to revisit in the near future, but I wanted to thank you all so much for joining our call, and we look forward to visiting with our clients again in the near future. Thank you so much.
Thank you.
Yeah.